Joining us now is Warren Pies, co-founder of 3Fourteen Research, to weigh in on really kind of the macro, Warren, and how it all plays into how markets are set up for this year. Are investors correct in feeling as if a Fed pause is a potential all clear for this market?
Well, great being here. Thanks for having me. I think that's what history tells us. History tells us that when the Fed pauses, you know, it's this Goldilocks period for across assets. And really, stocks have rallied during every Fed pause except for 2000, and that has some key similarities to today. Bonds rally also during every Fed pause going back to 1978. So, yeah, I mean, I think it makes sense to get revved up for it, but you got to put this whole move in context, and I think that we might be front running a little prematurely here.
So you think the market is, perhaps the equity market has gotten ahead of itself in maybe raising the probability that we're first of all going to get a pause, and that in fact the economy can escape too much damage?
Yeah, well, I think that historically, number one, when we looked at Fed pauses in our outlook for 2023, what we found is that every time you see the Fed funds rate and the two-year yield invert, and that means that the two-year yield is below the Fed funds rate sustainably, that has ushered in a Fed pause. Now, so I think that historically we're in the neighborhood where you'd expect a pause. But the other side of the coin is that, you know, the financial conditions have been targeted by the Fed, and this is not abnormal. Usually when you go into a pause, you see markets down by like 5 or 10%. So as the market tries to front run the pause, it becomes kind of a reflexive issue where they then push back the pause, you know, because the Fed is targeting financial conditions. Financial conditions is just a fancy way of saying stock prices, credit spreads, and stock prices lead credit spreads. They lead high yield spreads, which then lead investment grade spreads. So ultimately, every one of these rallies, in my view, is self-defeating. You're going to get some weakness before the Fed pauses. Otherwise, they're going to hang out. They're going to keep pushing rates higher, and they're going to hang out higher for longer, even if the inflation data is rapidly decelerating, which is what we also think is going to happen.
Yeah, this is a little bit of I guess, the dilemma that some investors see out there. So with the S&P at 4,000 at the recent highs, it seemed as if maybe the Fed wouldn't have been too happy to see that, even if, in fact, they can declare the mission against inflation almost won. Where do you think the market becomes more attractive if you think that you have this sort of fix that we're in where the Fed's going to push back against it?
Yeah, so we've been outlining for our clients a range for a while now between 3,600 and 4,000, and this is a rough range. You know, the market can obviously go shoot above that 4,000. It would probably need to do that to suck the most people in at the top here. You get a lot of breadth thrust and other technical indicators that have failed last year, and they keep sucking people in. So I think at the top of the range, markets start thinking about growth and earnings, and that's going to cap the rally. And ultimately, it's going to also bring the Fed into play because of what we were talking about with financial conditions. Now, you get a sell-off to 3,600. What's going to provide support is we've continued to say for months we see a path to 2% inflation in the next 6 or 9 months here. And it was out of consensus 3 months ago. It's becoming more consensus. But the bottom line is that you're going to continue to have this disinflation support. So I think that 3,600 to 4,000, call it a rough range, is going to be what we trade in here for a bit until we get more clarity on the economy. Now, what we see is ultimately there's going to be a recession. It's going to happen more in the back half of this year. I think consensus was we were going to walk right into 2023 with weakness in the first part of the year. In the economy, you have to account for the amount of stimulus and cash that's been injected into the economy. So I think this is a slower moving cycle than a lot of people had anticipated.
So you're expecting in the second half of the year is when maybe the weakness in the economy might become more evident, and that ends up being another gut check for stocks?
Yeah, absolutely. So let's think about it. The traditional Fed pause lasts 7 months. And so like if they were to pause on schedule, which would have been December of 2022, when this Fed funds rate and 2-year inverted, if we would have seen the Fed pause, they would have paused for 7 months. Historically, the recession doesn't come until a few months after that pause is done. 7-month pause is over. And that's because you have to think about the cadence of a Fed cycle. you're hiking rates, the economy's strong, bonds are struggling, stocks are kind of mixed. Then you pause, and it's this Goldilocks period like we talked about, where everyone has the optimism is off the charts. Maybe we could have a soft landing. If you go back and read Fed minutes, we always are thinking there could be a soft landing, but quickly that hope turns into reality that the recession's upon us. The Fed starts cutting rates. They're classically behind the curve. The stock market never bottoms before the recession starts in that classic cycle. So what does that tell us? It tells us that we should expect the recession probably in the second half of this year, and the ultimate lows for this bear market would be somewhere in later 2023.
All right. Yep. That is if the patterns hold, and if we get a recession, it's what to be aware of. Warren, it's great to have you. Thanks very much.